Hi everyone, and welcome to our webinar. Today's topic is loss illusions and great expectations. And thank you so much for joining us this morning. And before I introduce today's speakers, I would like to inform you that this webinar is recorded and that the recording and also the presentations will be made available for you a few days after the webinar. If you have any questions, you can ask them in the question panel. And you can see on your screen that you have a control panel. And if it's not visible for you, you can just click on that orange little arrow and it will show up. And on the bottom there, there's a question field. And you can type in your questions and send it to us. And at the end of the webinar, we will have a Q&A session where the questions are answered. And you can also reach us by email, and you can send an email to nordics@coface.com. And then I would like to introduce the speakers of today. You will meet the CEO of Coface Nordics, Pekka Puotunen, and Pekka will have a short introduction. And then our economist for the Nordics, Jonathan Steenberg, will go through the presentation, loss illusions and great expectations. And then I'll hand it over to you, Pekka.
Very good, Mona. Thank you. And indeed, very good morning from my side as well, from the sunny Copenhagen. And welcome to our first webinar after summer. I hope you have your morning coffees and teas right next to you, because I have a feeling we have an interesting 1 hour ahead of us. And obviously you came to listen Jonathan's views regarding Nordics and maybe a bit broadly what's the economic field is having for us for the last 4 months of the year. But let me give you a little updates from the business side. So I hope you all had the chance to enjoy summer break, but I have to admit, for us Coface Nordics, the summer was extremely busy times, and quite a lot has changed or happened between our previous economic webinar and today. And obviously by that I mean there has been quite a lot of changes in the business environment, unfortunately not necessarily towards the better or easier to forecast environment. Specifically, if we look at the Nordics, we have had a really interesting summer in regards to construction and real estate markets, maybe specifically in Sweden and Finland, where we've seen quite a fast deterioration in the underlying business activity. And of course, that is something that we've been very busy in terms of supporting our clients, both in the insurance and the business information side. And it's been interesting to see that the activity is slowing down quite fast. And of course, we see that also in the daily business. Moreover, we see more and more overdue notifications, which means that the clients are having issues to pay their invoices in time. But also now we've witnessed one handful of companies that have been, in our terms, big plus 100 million euro turnover companies going into bankruptcy or insolvency estate situations. So it is a really interesting times for us and obviously for you listeners to understand how the forward-looking world is looking like, what to expect, where are the risks, how the risks can be mitigated, and moreover, it's going to be extremely important to understand trade relations. The more we have big zombie companies going into bankruptcy, they will have effectively impact to companies down the line in the value chain on the supplier side. So it is going to be a really challenging and complex environment to navigate going forward. And I think moreover, for that reason, today's session is going to be interesting. We have Jonathan, who is the economist for the Nordics, to give you a little bit more insights where we are today and how the short midterm guidance is looking like and what to watch out. So without further ado, let's bring in the star of this morning, Jonathan. The stage is yours.
Perfect. Well, thank you for the introduction. And I'm quite happy that the Pekka started this by saying it is interesting times. Because going into this, I was slightly worried because this is the first time I've gone into one of these introductions, and sort of in the last 3-month period, there hasn't been a global pandemic, a cost of living crisis, an energy crisis, supply chain crisis, or an actual war in Europe in sort of the last 3 months before we did one of these. But despite the fact that there aren't as many sort of big headline news, and that's a good thing, both for the global economy, but also just for everyone's stress levels, I still think it is very interesting times because all the things I just mentioned finally had the time to feed into the economy. And all these things that we've been experiencing in the last 3 years are now feeding into the economy. And that actually means that despite the fact there might not be as many headline news, I think the real impacts for all of us on the economy, on our day-to-day lives, is now more clear than ever. So before I go into that, I quickly want to add that we're generally going to start a bit wider, sort of the world, some key trends, and then go in more towards sort of what is happening in the Nordics. So we will get to the Nordics, but I will have some more sort of general trends to start with as well. So the first thing I want to show is the Coface country risk map. So 3 times a year we update this, in which we look at the business defaulting risk in countries. So unlike credit rating agencies that focus on sort of sovereign debt, we are focusing on the business defaulting risks. And as you can see, if you generally operate in a North America, Western Europe kind of world, then we are generally in what we'll call a very low to reasonable defaulting risk level. And as more closer you get to Latin America, Central Asia, and Sub-Saharan Africa, we get to slightly higher defaulting risk levels. Something that was quite nice that we did in the latest update in June, which this one is from, is that we actually saw more upgrades than downgrades for once, and that has not been the story we've seen at all during 2022, where I will say that dark gray color was dominating this map. So while there are many worries, we are also seeing some good signs. However, if you're mainly operating in this North American, Western Europe, Northern Europe, it's sadly not where we see the majority of these upgrades. We are more seeing emerging markets seeing some improvements. Some of these are slow recoveries from COVID. One thing that advanced economies did have advantage for is that we recovered quite quickly, at least most countries did, whereas some of the upgrades we're seeing now is still downgrade from back in COVID and then first recovering from now. But another trend you'll see for many of these is a lot of these are either commodity exporting countries or sort of very big in the tourism industry. And so if we just quickly go through some of them, Kazakhstan, Uzbekistan, we had a lot of fear how they'd do after the war in Ukraine, but generally we're still seeing a strong recovery. They're big in the oil, gold exports. We look at Qatar, Saudi Arabia, obviously natural gas and oil, very, very big, but we're also seeing a lot of investments in the non-oil industries, which means we are seeing sort of solid, also non-oil growth in these countries. Nigeria, very, very, very big. New election, which went better than we thought. They're also increasing their oil refinery abilities. So once again, a country that is seeing some positive growth there. Tanzania, tourism, and to be honest, a lot of commodities as well. We have Cape Verde, Malaysia, and Philippines. These are mainly related to tourism. Still a slow recovery after COVID, but the latter two are very much also benefiting from the Chinese reopening, which, while not have been as nice as many of us hope in sort of generating global growth, it has meant that Chinese tourists are back in the global scene. And closer to home, we saw an upgrade in Greece, which is sort of threefold based. Tourism is doing better than usual. The economic recovery is still quite stable. Political instability is improving, and lastly, we are seeing upgrades in the government debt assessment from these credit agencies that I mentioned earlier, and that means that some of them are sort of increasing Greece once again. And for some of these, it means they go from junk rating to investment grade, and that has a lot of impact on sort of foreign direct investments into the country. So in that way, Greece we saw as a sort of more benign environment. And Ireland, I was about to say, is Ireland. A very big multinational presence there, especially in pharmaceuticals and ICT, which generally has been doing quite well in the last few years. And some of the underlying risks that we were quite worried about, which was that trade relationship with the UK and OECD tax agreement that could result in some potential multinationals leaving, sort of has not materialized. So we believe that the environment in Ireland is quite benign. In regards to downgrades, we still saw two, and these are related to sort of a more general inability to honor debt. To be completely honest, Kenya is having some debt issues. They are basically in a situation where they need to choose whether to pay their debt off or pay their employees, the government employees, which is not a situation you want to be in. And Bolivia is facing a proper sort of hard currency crisis. Basically, their reserves are quite low. They have a hard time obtaining them, which means that not just the government will have a hard time honoring a US dollar or other foreign currency debts, but it's generally hard to come by for companies as well. So that was sort of like the global map. Before we sort of go into the right now and the what's about to happen, how we see the world, a really important question is that question of where are we actually now? Because I think a lot of us are hearing the news, and one day we hear one story which sounds like the world is going great, and then the next day we see another news and we're thinking, oh, maybe it's actually not that good at all. So I really wanted to start here by sort of giving that overview of where are we right now. And if we look at the US and the Eurozone first, the US, to be completely honest, is seeing quite stable growth. While there are some worrying signs, interest rates are high, we are seeing some weakenings in the labor market. To be honest, US demand is still relatively stable, and we are seeing a lot of government investments sort of compensating for a slight fall in private ones, and a lot of subsidies, which means that some private investments are increasing in sort of selected sectors. So the US growth, while slowing down a bit, is still relatively stable, and this dream of a soft landing in the US or very shallow recession might actually be possible. And you're seeing that on the left hand side here, which is the fact that while there is a slowdown in growth from 2022, it sort of is continuously increasing. In the Eurozone, the story is similar but weaker. Generally speaking, some European economies are still doing relatively well. Some are also still recovering from COVID, to be completely honest. We are seeing some, in particular Southern European countries, that are still sort of seeing the rebounds from COVID, especially if they're heavily reliant on tourism. And we are seeing other countries truly struggling. That's countries like the UK and Germany that are either seeing falling or just unchanged level of economic activity. And Germany in particular is really feeling the brunt of high energy costs and a global demand that is coming down. And if we look closer to home, Sweden is a perfect example of a country that's seeing similar trends to Germany. Sensitive to the high energy prices, demand is coming down a bit as inflation keeps being quite high, and the export environment is not what it was. And that way you can sort of see that in the past year, the Swedish economy has stagnated, and the last quarterly growth we saw, which was Q2 for this year, actually saw quite a significant drop, sort of similar to what we saw in Q4. So Sweden is definitely responding to this sort of slowdown in global economy and high inflation environment. One thing that I wanted to highlight is that sometimes these figures can be a bit misleading, because if you look at somewhere like Denmark, you're seeing quite a lot of strong growth. You can also see on the left-hand side, Denmark kept outperforming most other economies. But what should be highlighted is that this is very, very heavily reliant on the pharmaceutical industry. So if you remove pharma from Danish GDP, the picture would, if we're being honest, look far more similar to Finland, in which we have seen a roughly stagnating or even slightly falling economy over the last year. So while the headlines in Denmark sound very nice, we are still seeing an economy that are seeing some quite difficult signs. If we look at Finland, we've seen a fall since last year. Finland actually went into a technical recession in the latter half of 2022. And the first 2 quarters of 2023 has seen some improvements. But I would say that you should take this with a grain of salt, to be completely honest. Because if you look at something like Q2, about 0.4 percentage point of this increase is government spending. So that's more the government being interventionists. And some of this 0.4 again, and you can see we'll very quickly get to a negative here, is net exports. And it's net exports not in the way you'd like, which is growth in exports, but imports falling more than exports. So basically, sometimes what you can see in a slowdown in the economy is that people start consuming less, but they start consuming less of imports relative to domestic goods. And because how sort of GDP is made, you can see a slowdown in consumption, meaning a positive effect on the economy. So I will say, while 0.6% in Q2 looks very nice, this is a bit of an artificially high figure, and the Finnish economy is still in a difficult state. And the Norwegian economy is a bit of the exception here. Again, we have seen a lot of exports of commodities, natural gas and oil, which Norway obviously has a lot of and exports a lot of, which means it has benefited from this, and there is still a lot of economic activity. But as you see in the latest figure, this is definitely slowing down as well. So while the economy is doing better than many other countries, we are definitely seeing a bit of a stagnation there as well. So what I really wanted to highlight is sort of, again, give that idea of where are we and where are we going in the just immediate future, and then we'll look at 2024 afterwards. And one thing that I think has confused a lot of people, including a lot of economists, is sort of how can you analyze an economy that have been defined by government intervention in the last few years? Because basically what COVID caused was a break in certain parts of the economy, in certain parts of the world, while letting other things continue. And that meant that, as you can see on the left-hand side, we saw a quicker recovery in manufacturing, because while we were all locked down, we wanted to buy goods, and that meant suddenly the manufacturing sector was actually doing quite well. Then the world started opening again, and the service sector started doing a bit better as well, as we started using more services as opposed to buying all these things for our home. We started buying less goods. Then suddenly we saw a war in Ukraine, but not just that. We also saw lockdowns in Shenzhen and Shanghai in the beginning of 2022, which both exaggerated a supply chain issue that had been building over the last year. It was something we kind of could see as an underlying trend, the fact that we were suddenly demanding more goods while sporadically closing down around the world, meant that sort of there was some inflationary pressures that were building up. But once we saw war in Ukraine, energy prices coming up, lockdowns in China, which meant we even had a hard time producing several things, we really saw a contraction in manufacturing. And as you can see on the left-hand side, manufacturing has been contracting for more than a year. So pure manufacturing is having a difficult time. But as energy prices and inflation kept rising, interest rates followed in 2022. Even services felt the brunt of it. It slowed down as we all were grappling with the fact that things were getting more expensive, and usually inflation was growing higher than our wages, which means in real terms, we were becoming slightly poorer. And then we were looking towards a winter that some of us were quite worried we'd not even be able to have enough energy for, and energy prices shot up, peaked around October, November last year. And what happened then was a relatively warm winter. And that warm winter meant that energy prices came down very quickly, which meant you suddenly saw a lot of optimism in the economy in January, February this year. And that actually meant we saw a bit of a boom in the service sector. And you can see that on the left-hand side as well. Now, this is partly based on the US and Europe seeing inflation coming down and some optimism. It's also the reopening in China, which didn't do much for manufacturing, but actually meant that the Chinese were allowed to go out to restaurants, to travel, both domestically and international, which meant we saw a bit of a service sector boom that kept the economy going in the first half of 2023. However, this also had some consequences for us because central bankers want us to slow down the economy. And so we saw this last boom, which went against what they were hoping to see, which was a slowdown that would push down prices. And speaking of prices, I have to mention inflation. I'm sorry about that. I think it's something everyone is tired of hearing about, to be completely honest. You know, it's bad when even comedians are talking about inflation, and I will say it's a boring economist joke, but I think one of them, I saw a comedy show, one of them started it with saying, I was going to do a joke about inflation, but it's just not worth it anymore. That's a very niche economist joke, but if you find that funny, well, you're a bit nerdy like me. But basically, we can't stop talking about inflation because it's still here. And while this slowing down, it is still high. And the important parts of it, and that's what I really want to highlight, is still even increasing in some Nordics countries. So we start on the left-hand side. That's headline inflation. That's the one central banks would prefer to get down to 2%. And as we see, Denmark got relatively close, saw a slight uptick. Sweden is still really fighting with this. This is partly due to the fact that there's more floating interest rates there, and those feed directly into inflation as well, which means increasing interest rates also cost higher inflation, which is a bit of an annoying short-term effect. Norway, while never seeing inflation increase to the same degree, has seen quite sticky, even headline inflation, but still, as a whole, most of these are coming down. But if we look on the right-hand side, we're seeing a different picture, and that is the core inflation. That's where we remove food and energy, which are the most volatile parts of this. And as we see in Denmark, which had very nice headline figures, core inflation is still quite high, and it's only coming down a bit. In Sweden, very, very high, coming down, but stabilizing a bit. And lastly, in Finland and Norway, they are still even slightly increasing. And that's something that central bankers really worry about, because what they fear more than anything is this wage price spiral. And that basically means that we get so accustomed to higher prices that we want a higher wage. So high increase one year means we see a higher increase in our wages. And we also saw that this year. High inflation in 2022 meant that on average, we saw a higher nominal increase that we've seen in a few years, even if it wasn't enough to cover inflation. But a higher nominal cost is still a cost to a company, which means they'll have to increase their prices. And if they increase their prices next year, if we still have a relatively strong labor market, then people will say, well, we want higher wages as well. And again, then we end up in the spiral, because higher wages next year will mean higher prices. And then getting inflation back to sort of a sustainable level gets quite difficult. And at the same time, right now, we're benefiting from energy pulling down negatively because it was so high last year. But one thing we need to remember is energy is still in a high level. And what we are seeing is that supply is still relatively, I'm not going to say insufficient, but it's harder to come by than it used to be, which means that small changes in demand means quick increases. And that means that we could easily see in the next year, especially towards the end of next year, that energy starts contributing positively to inflation again, which means that one of the things that should be pulling down will start contributing positively again. And that will mean then that getting down to the 2% target will be quite difficult. And that sort of feeds very nicely into central banks and the interest rate. Because one thing I think many were saying throughout the year was, when will the pivot be? When will we start seeing hikes stop and cuts start? And one thing we want to highlight is that we are not in a cutting cycle yet. We've slowed down the hiking cycle, and you can see that on the left-hand side. The peak hiking cycle is over and slowing down, but we are still seeing far more hikes than we are seeing cuts. And while this is slowing down, we still haven't seen an advanced economy's central bank cut since start 2021. So hikes are still more likely than cuts. Now, what that means for sort of the central banks important to us in the Nordics, we can start with the Fed. While not being in Europe or in the Nordics, it is still a defining one on a global level because of the importance of the dollar. And we do see some signs that it could maybe pause from now on. So while we are seeing high inflation and higher core inflation than maybe the Fed would like, it is slowing down. And the labor market, while still strong, is showing some signs of weakness, which is also feeding into wage increases. At the same time, we do think that there's a balance there of both fighting inflation and financial and economic stability, that the Fed would maybe sort of take a wait and see approach, see how these high interest rates will feed into the economy. And one of the things that we're really worried about is not just the level, but also it's when you change. Because what something like the Fed is worried about is every time they've talked about slowing down, the market basically starts saying they'll start cutting. So for Fed, it's really a fine balance between the fact that they want to stop, maybe don't want to cut yet, but they want to sort of ebb out the increases. But they're so worried that the market will basically turn the second they pause and say, now we're getting into a cutting cycle, that we'll see a reversal in the banking sector, which is not what they want. They still want to slow down the economy, but they're not sure they need more interest rates. And if we get closer to home and see something like the ECB, they are in a similar situation, which inflation is still too high and core inflation is still quite sticky in the Eurozone. But we are seeing slowdowns in economic activity to a larger degree than we are in the US. And again, you want to balance between economic activity, unemployment, and inflation. And especially when a big economy such as Germany is seeing a slowdown as it is, that will weigh in a lot on the ECB's decision. And at the same time, to a larger degree than in the US, high interest rates have effect on the government budget of some European countries, especially somewhere like Italy, which is very sensitive to a high interest rate environment for a longer time. And because of that, we do believe the ECB will pause from now on. There could potentially be one more hike if the data is really bad, but we do believe the balance between inflation and still maintaining a certain amount of economic activity will mean that they are done for now. The Danish central bank is obviously pegged to the Danish crown is obviously pegged, so they more or less follow the ECB. And with the current exchange rate, we do believe they will more or less follow here. We could maybe see a strengthening of the Danish crown, which means we'd see a minor cut in Denmark, but that would again mean quite a bit of a strengthening in the Danish crown versus the euro. If we look at Sweden, we do believe there's at least one more cut in them. Again, inflation is high. Swedish currency is still weak compared to the euro. It usually is a counter-cyclical one. So if there is some financial or economic stress, people have a tendency of going towards the euro or the US dollar. So we would expect it to be slightly weaker than when the economy is strong. But that being said, we still wouldn't be surprised we'd see at least another 25 basis points. And Norway, we expect at least 25, but potentially even 50 basis points more towards the end of 2023. And that's because, as I said, core inflation is still rising and the economic activity in Norway is still more stable, which means you have a bit more wiggle room if you want to try to slow down the inflationary trends. So to sum up, we are looking at maybe a pause in some countries, but in Sweden and Norway, we'd expect at least still one hike. And if we look at 2024, we don't see them sort of starting cutting until at least summer 2024. So we are looking at almost a year of the current interest rate environment with even a bit of a higher premium in some countries. So if companies are struggling in the current environment, the next year is not going to look that much better. And one of the reasons why central banks are doing this is because they want to slow down the banking sector. They want to slow down credit. Now, they were slightly helped by this, by the banking crisis back in February, March. Don't know if you remember that, so long ago, but we were a bit worried about a little banking crisis in the world again. And while it didn't really materialize as much in Europe, it did sort of start a trend that was already starting by a deterioration of the economic situation, by higher interest rate. But suddenly banks started looking at their balance sheet and started thinking, maybe we do need to be a bit more restrictive. And as you can see on the left-hand side, this is surveys to banks asking, where do you see the credit standards that you are giving to non-financial corporations? And they are tightening. And every time it's below 0, that means it's tightened compared to the last period. So we have seen 5 consecutive months for example, the Danish central bank's survey that indicate that Danish banks for now more than a year have been saying we are becoming more and more and more tight. And that is starting to have an effect. One, we can see it in data. I'll get to that in a moment. But we are also hearing anecdotally in Coface that we are seeing clients who are saying, well, some banks are cutting credit limits. Some banks are less interested in refinancing certain loans. And that's having a real impact. And again, as we can see in hard data, that's the graph on the right-hand side here, the net debt to non-financial corporations, so that's why you remove what they pay back, is falling very quickly, and especially in Denmark and in Sweden. It's coming down very, very quickly, which means there is less credit in circulation, and companies that might very much need this for liquidity reasons are having a harder time attaining debt at the moment. And this is sadly not spread evenly. Usually the companies that are hit the hardest by this are the ones that need it the most. Small and medium-sized enterprises are always seeing higher premiums and are usually the ones that see these tightenings affect them the quickest. So small and medium-sized enterprises will feel the brunt of this quicker than the large corporations. And what will this mean? Well, I already mentioned the interest rate rise, but I really want to put that into perspective for you guys to sort of understand how serious this actually is for a company right now. Because something we've been talking about, I'd more or less say for 15 years since the global financial crisis, is these zombie companies. And just quickly to define a zombie company, that is a company that more or less make enough to cover its interest payments. But that's basically it. It's surviving year on year. And when you have a low interest rate environment, which we have had since the global financial crisis, which central banks cut rates across the world, the emergence of these zombie companies have increased. Basically, companies that in a high interest rate environment would go bankrupt, but because the interest rates were so low, they managed to year on year survive. This also resulted in general debt levels in the world coming up quite quickly. And as you can see, in start 2005, in the Nordics, we were between around 80% in Finland to the highest in Norway, just a little above 110% of GDP, to before the pandemic, we're already around at least 20 basis points higher in most countries. Now, COVID happened. A lot of companies had to take on new debt, simply to survive the hardest bits of it. And some of it were cheap debt. Again, remember, like central bank debt at that point, very central bank rate very low, which means debt was a lot cheaper. And we saw an increase. And in many countries, this sort of went down a bit, still elevated, but companies took on debt in 2020-21 and slowly started to pay it off. But in some countries, in some sectors, that has not been the case. And one that you can especially notice here is Sweden, which, to be honest, took on a lot of debt during COVID, the companies there, and they haven't really been able to pay much of it off. So that means they're very sensitive to these high interest rates, especially as floating rates are very, very, very popular in non-financial corporations. Now, what does that actually mean for one company? Well, if go back to the first slide, the first graph, the one on the left-hand side, you can basically see the average interest rate for a private non-financial company. And that means that if you took on debt in 2021, as an example, that would have cost you 1.5 percentage point in Finland, around 2% in Sweden, around 2.5 in Denmark and Norway. Now let's say that was a 2-year debt, that would bring us to around now. Well, right now, that same loan, if you had to roll it over, would cost you about 5% in Finland, 5.5 in Sweden, close to 6 in Denmark, and above 6 in Norway. And again, we still haven't worked in the fact that the banks are still increasing their premiums on top of the bank rates. And as I mentioned, we are expecting that both Sweden and Norway will increase their central bank rate by at least 25 basis points. So if you're back in 2021 and maybe you took a 3-year debt, you need to roll it over by the middle of next year. If we take Norway as example, that would maybe have looked like you took a loan that cost you 2.5% and now it costs you 7.5%. So that's a threefold increase. And that is why that some companies, these zombie companies that more or less were only able to pay back their interest, are suddenly seeing a lot more difficulties in surviving this zombification. And this is feeding into our forecasts for both 2023 and 2024. Because we do believe that stagflation is going to be the defining feature of not just this year, but also the next year. Inflation will be going down, but it will still be high. Interest rates will remain high and growth will be timid at best. The recovery in China will be there, but it won't be as strong as we hoped. And while many of us would probably think that, almost 5% annual growth is very nice, from a Chinese perspective, this is quite low. And a proper restart of the economy is not really happening because, to be honest, China is facing a lot of different issues right now. Geopolitical tension with the US means that foreign direct investments and exports aren't doing that well. On a domestic level, they are fighting with an ICT sector that they cracked down on. That used to be a big employer, along with the real estate sector, which no one's really investing in that right now. Because one thing that people really didn't think about was the fact that actually China invested so much in real estate that if you look at the average house per house ownership in China, it's almost better than the US, despite the fact it's a very poor country. So you also reach a point where you're thinking, well, what would be the future investments in real estate look like if almost everyone already have a house? And that has been a key driver of growth. And also after their lockdown, the domestic demand, it didn't die out, but compared to Europe, where we had these very generous support measures, they haven't really had that in China, which means exports are weak, but domestic demand is quite weak as well. People aren't really sure about believing this recovery, and with youth unemployment at only around 20%, there isn't a great optimism in the economy. So that means that China, as the growth engine of the world, is not something we're expecting to see in the next few years. US I've already mentioned, and in Europe we'll see sort of a mixed bag. To be completely honest, similar to the Nordics, some countries are still doing relatively well, but relatively well will mean averaging around 1% year on year, which is quite weak growth. And some countries will struggle, especially this year. That includes the UK, Germany, and Finland and Sweden. And while there will be a somewhat increase in activity in 2024, as inflation slowly starts coming down, even if it is quite sticky, it's not going to be a strong recovery. So slow growth, high inflation, high interest rates will sadly be what defines this year, but also the next year. And what does this mean for companies? I really love this equation because I really want to highlight the fact that what we've been seeing in the last few years was quite abnormal because we had so much government intervention. We had a massive eruption of the global economy that didn't result in companies going bankrupt. We actually saw lower bankruptcies than we'd seen for decades. And that's basically because of government intervention. But that is done now. Government support measures are over. The energy crisis measures are being phased out. And that's happening at the same time as the cash position is still affected by the fact that commodity prices are very volatile, wage costs are increasing. So the liquidity and the margins are getting more difficult. I won't even go into the financial sector because you've heard from me talk about that a lot. But at the same time, what I also said is that we are seeing a slow growth. This stagflation means that demand is quite timid. It's quite slow. And we are seeing this effect happening in the Nordics as well. So while people had this, I'd say, almost party mentality after COVID, I wanted to go out and spend money because I haven't been able to, that is slowing down and households are consuming less and less. And we're also seeing this in retail sales, which are falling quite a lot. So the party is over in regards to spending, and that is happening at the same time as high interest rates and high costs. So companies are in a difficult squeeze right now. And that does mean that we are seeing insolvencies come up. And that is more or less across the board. There is the one caveat here with Denmark, which I know it says minus 32%. All of these are compared to 2019, the last like full year without any government intervention. And while this says minus 32, the Danish insolvency figures can at times be slightly misleading. If you look at active companies instead, the picture is more similar to Finland and Sweden. And that's the one we're mainly going to focus on, because that's more representative of the effects that have on the actual economy, what turnover is affected and how many jobs will be affected by these companies going insolvent. Norway is still seeing a gradual increase in insolvencies. Now, it has been one of the slowest countries to do so, but that is partly due to the fact that the economic activity in the country has still been relatively strong, but it is still increasing year on year, even if it's still below the 2019 level. Sweden have seen a quite quick acceleration after still slowly returning to normal levels last year. And the same with Finland, which more or less came back to the same amount last year, is now seeing an acceleration as well. And on the right-hand side, I've taken the jobs affected by these insolvent companies. Because what happened in, for example, Denmark initially was you saw a lot of insolvencies, but these were all inactive companies with 0 to 1 employees. But if we look on the right-hand side, we are now seeing the real impact on the real economy, because jobs lost have now increased above the pre-pandemic level in Denmark. And again, that's where the Danish economy can be a bit weird at times, because if you look at GDP, it's great. But if you look at something like the jobs lost in insolvent companies, it's leading in the Nordics, and not in a good way. Finland has returned to normality again, and Norway and Sweden are slowly coming up there. But as you see, the trend is only going one way. And that's a peculiarity, as you see, because the Swedish figures as a whole are above their 2019 level. And that's again what Denmark saw a few years ago, which is initially it's these very small companies that go insolvent, and then slowly you start seeing the bigger ones fall as well. And that's very usual in a crisis. The smallest companies feel the brunt of the crisis first, and then it works its way up to larger and larger companies. I think something that many people wonder about is where is these increases coming from? And sort of the simple question is everywhere. to be completely honest. On a year-to-year basis, the increases are happening a lot of places, but then again, that's partly just a normalization of these abnormal government support years. But some sectors are definitely sensitive. Pekka already alluded to one of them. Construction, real estate are seeing increases in most of the Nordic countries. Other sectors are seeing it as well, especially if you're energy intensive or quite sensitive to interest rates. Somewhere like chemicals, you will see being on the high end. It should be said there's not that many chemical companies, so a small increase will look quite big from a relative point of view. But chemicals is one of the sectors that's definitely also having a difficult time because it's quite energy intensive and sensitive to natural gas prices as well. But as you can see, with some sectors being particularly affected, the overall trend is still it's rising across the board, and that's because many of the trends that I've mentioned so far affects everyone, to be completely honest, but some are more sensitive to it. If you look at Norway and Finland, another one that will appear a lot is hospitality and recreation, as well as textile and clothing, which are very sensitive to a fall in consumer spending and a fall in the service sector. So while hospitality saw a bit of a revival as people started going on holidays again, people started going out, as the service sector is slowing down, they are dealing with very high costs. They're very sensitive to high labor costs, and as wages, nominal terms, are increasing more, they're very sensitive to that. At the same time, as you know, if you have a restaurant or a hotel, you need to keep it lit, you need to keep it warm, which means high electricity and gas prices will also affect you. So some sectors are more sensitive than others, but if you look at lastly our sort of regional sector risk assessment map, so we do country risk assessments, but we also do sector risk assessment for 30 countries across the world, and we've here aggregated them for some regions. You can see that in Europe we are generally in a high risk to a very high risk environment with few medium risk sectors. ICT and pharmaceuticals are still doing relatively well, even if there is also some signs of weakness, and as you can see, we are seeing some downgrades here as well. But we are generally seeing that the risk level is higher. We are coming back from an abnormal time, and companies are going into a very difficult time. So there is difficult transition period right now. So transition risk is not just something you see in ESG, it's also very much at the moment true for profitability and liquidity. So what's the key takeaways you should take away from this? Because I am aware I've been speaking for a long time here. Basically, high inflation and high interest rate will stay for a while. That means for your counterparties, you have to understand their debt level, how indebted are they, what's that structure like? Is it completely floating? That means you're very sensitive. And how's their refinancing needs looking in the next year? Do they have some debt that needs to be rolled over? Do they have some bonds that needs to be paid back? If they do so and they want to refinance that, that's going to be a completely different picture than the last time they did it. Cost will remain high, which means you need to understand if your counterparties are able to pass on these costs. Are they in a sector, in a position in which they can change their prices, or are they quite firm? Because if they are, they will definitely see their margins being squeezed. Because we are, no matter what, until 2025, 2026, in a world where at the very least energy prices will be very, very volatile. And lastly, understand that consumer spending is now falling. Habits are changing. And you need to understand if your sector is sensitive to that. Is that something that people will still demand? Is it an essential, or is it a miscellaneous item? And I think I will end on this note. I think we have about 10 minutes left. If you have any questions, as Mona said, you can always contact us or me or any of my great colleagues, and we can obviously share the slides as well to people if needed. So I think I will stop here for now.
Thank you so much, Jonathan. Then we are in our Q&A session. And I think It was very clear, your presentation, because I cannot see any questions.
Or is it just the Nordic way?
Yeah, maybe it's the Nordic way. But if you have any questions, we are following the chat and we are following the question panel. So just write them in.
I can maybe quickly ask Pekka, because something that again I mentioned here is really this difficulty in the financial sector. Attaining finance, even refinance is getting hard. This sort of credit limit being cut by banks, or banks being more tight. Is that something we're also seeing in the Nordics as well, sort of across the board in all countries, or is it more selective, would you say?
I would say luckily so, it's more selective. It's basically more directed to the really distressed sectors, which I think we've touched today a few times. So luckily it's not really a big thing yet, but we do see that, and rolling over for new terms is getting more and more expensive. More collaterals are needed if the structure has been non-collateralized previously. So it's becoming more, let's say, challenging to get the finance rolling. And then of course we have really challenging pockets in Sweden, where the real estate structures have been funded and very differently compared to maybe Finland or Denmark. So then when you are fully funded through bond issuance and they are maturing, let's say within the next 24 months, quite a substantial amount, are you able to actually lock that financing forward is the question, and with what asset values behind. So it's a really delicate, challenging dance, specifically on the real estate side, which of course will have an impact to the activity in the economy. We have seen quite an interesting forecast on what it will do to the unemployment rates when more of new builds are not being started, and new build submissions are significantly decreasing from what could be maybe extreme high levels that we saw. So we're coming to this environment from extreme high, and now we are probably seeing extreme low. So it's quite a swing, and it's not easy for the economy to absorb that without some distress.
No, I will say we've been looking a lot at commercial valuations, and in the Nordics those have fallen quite a lot. So if you sit there as a real estate company wanting to refinance, the collateral can have fallen as much as 40% in some cases, because if we're completely honest, the world of office space was completely reimagined after COVID. And sort of high street retailers, I mean, we all got slightly more used to buying online. So there are some structural trends that also just means that if you are a commercial real estate owner with a portfolio spread across these sectors, it's a difficult time, and especially in the Nordics.
Yeah, and the current risk-free interest rate levels are not specifically helping the evaluation game. So there is definitely a price pressure, which will trigger a lot of things. But let me turn a question back to you, Jonathan, because I think it's really interesting and extremely important for the participants today to figure out how to move forward. We hear a lot about inflation. Then traditionally there has been some discussions of deflation. Now we have stagflation, which to me is probably the most challenging and worrying inflation to have as such. And then, of course, if we look at the Nordics, we are quite export driven, but also we have domestic consumption as a big part of the GDPs. But where do we export from the Nordics? We export to other Nordic countries and then to the Eurozone. And then we see stagflation being the nominator for Eurozone. How do we get out from this? Because obviously the inflation is building and it will continue to be building thanks to the core inflation being really sticky. So how do we get out? What's like, because I can imagine Lagarde and ECB is having a really difficult path forward to get us out from here.
I mean, to be completely honest, the easiest way is slow and steady growth, which is also the most boring solution, and also will be a real struggle for some companies. Because at the end of the day, if we suddenly saw a massive increase in, let's say, government spending, that would be inflationary.
Yeah.
And then you basically have a Ministry of Finance fighting the central bank.
Yeah.
And we have seen that in some countries. And truth be told, then you just see the central bank raising interest rates even more. We want to see a slowdown in the economy. So what we're seeing right now is, to a certain degree, what I think some central banks was hoping for, but in the Eurozone, at least in some countries, a bit of a bigger slowdown than they were hoping for, especially in somewhere like Germany. But to be completely honest, there isn't an easy solution. This is one of those times where you got to tighten the belt buckle, and you got to accept the fact that we are in a precarious situation in which, as long as the energy supply keeps being quite tight, we can't really see, a massive increase in growth, because that will be inflationary. We'll see energy prices coming up, and we already see that sometimes. If there's suddenly there might be a bit of a bigger recovery in China, energy forward starts increasing. Germany might actually not be doing as bad as we thought. Energy futures start increasing. The US economy might actually see a soft landing. Energy futures start increasing. Because we are in that situation where we are very dependent on the LNG market, which is a global market. It's a very volatile one. So until we've sort of fixed that, and we do have sort of a better idea of when that will be improving, but that is 2025, 2026. But until that point, slow and steady wins the race.
Yeah.
The old Greeks are right.
Yeah. Let's see how that works. It's funny you should mention that there are these different forces in play where we should have some ability to observe the slow growth, but there are also initiatives where maybe income tax will be decreased, which would mean that we will basically do actions to keep the situation ongoing and maybe pushing it even further and forward. So it's going to be interesting to see how it will all play out.
Definitely.
Yeah, absolutely. And then we have a question here, actually. So it says, great presentation. Do you see challenges in lender obtaining funds for lending to smaller businesses as a result of risk weighting regulation, capital retention? What can insurers do to assist?
Yes. Yeah. To be completely honest, and as I said, it's sadly the smaller the company, the harder it is to obtain debt in periods of either financial turmoil or just restrictiveness. So it will be harder. It will be more difficult. Again, insurers could help here. I'd say transparency. The more information you share, the more we can help you, the more the banks can help you. It's about good information. It's about proving your business case. And that's really the way to be about it. Transparency is the key in these kind of situations.
Yeah.
Thank you, Jonathan. Then we are on time. It's 10 o'clock. So thank you, Jonathan. Thank you, Pekka. And thank you to our attendees. We'll see you next time.
Thank you very much.
Thank you.
Bye.
Bye-bye.